Welcome. Thank you for joining us for this webinar, Maximizing Employee Retention Tax Credit and PPP Forgiveness. I'm your moderator, Renee Goodnow from the New York Small Business Development Center. As you can tell, I am not on camera and none of our presenters are. We are going to say that it could possibly be a GoToWebinar glitch. We would love to have our cameras on and have you see us today, but it does not look like it is in the card. So we do apologize for that. This presentation is being recorded because we will be sharing it shortly after today's webinar. You will not be on camera. If you do not wish for your voice to be included in the future replay, please type your questions into the questions box. As I mentioned, questions, if you have any at any point, please put them in the questions box and we'll answer them as we go, as well as at the end. I mentioned sharing today's recording. We can also share the slides if they are requested. Your host today is the SUNY Canton Small Business Development Center, and joining us to introduce our presenters and lead things off is Angela Smith. Angela, I'll turn things over to you to introduce yourself and today's presenters.
Thank you so much, Renee. Hi, everybody. My name is Angela Smith, and I'm a disaster relief advisor with the SUNY Canton Small Business Development Center. If you're not familiar with our program, the New York SBDC has 22 centers across the state, and we are a part of a network of over 900 centers nationwide. We provide free business counseling to startups and existing small business owners. We also providing disaster advisement services to help business owners reopen and relaunch. Our free services are made possible by funding we receive from the U.S. Small Business Administration, the state of New York, and our host institution, SUNY Canton. Center to you or to get started with an SBDC advisor, please visit our website at newyorksbdc.org. Today, we're going to talk about the employee retention credit and how to use it when you also have a PPP forgivable loan that you're utilizing. We're finding that many owners are not aware of the ERC program and how the tax credit of this COVID relief program can really add up. Just on another webinar with a colleague, she shared that one of her clients had received $160,000 PPP, and with some planning and guidance from their accountant, they were also able to identify $40,000 in ERC credits. This is real money that can go straight to your bottom line. So hopefully today we can help you find some real money. It's important for me to remind everyone that SBDC advisors cannot give you tax or legal advice, but we can share information so you can make the best decisions for your specific situation. This is why, as always, we like to team up with the experts to help you learn more on how to maximize ERC and PPP programs so you're not leaving money on the table. Today we have Doug Hoffman, CPA, and Dennis Vincenzio, business coach from the Hoffman Eells Group CPAs, and they will be leading the presentation and helping to answer questions. So without any further ado, I would like to welcome Doug and Dennis. And I believe, Dennis, you're kicking off the presentation. And before you get going, thank you so much to both of you for contacting us, offering to do this presentation today. Really important topic. And as always, thank you for supporting small business. So Dennis, I'm turning it over to you.
Angela, thank you very much, and welcome everybody. I've seen questions already starting coming in, so hopefully we will be able to answer those questions. That's our goal. So I'm going to start right off with who are we? So as Angela said, Doug Hoffman is the former managing partner of the Hoffman Eells Group. We are the largest CPA firm in Northern New York. Doug has 47 years experience as a CPA, MBA, certified business coach and speaker. And he's also the founder of CFO to Grow, providing financial marketing, strategic business and consulting services, as well as a virtual part-time CFO controller. Myself, I am a business coach with 35 years of experience assisting small businesses. I've worked as a CFO and controller for many small businesses with backgrounds in retail, automotive, RV, manufacturing, and construction. So as always, the goals of our presentation is to give business owners some tools and concepts they can use for planning purposes. Information presented is in a generalized manner. Every business, especially in this topic, has some specific considerations when applying these tools and concepts. And a big disclaimer for this one, we are going to give some tax advice and or recommendations. We advise strongly that you reach out to your tax advisor for specific advice on your specific situation. So let's jump right into it. We have a lot of material to cover, and it is, in the case of this, can get very detailed. So our overall theme here is we don't want you to leave any tax credits unclaimed. There's an employee retention tax credit that's out there that some people are aware of or not aware of. And in 2021, the credits that are available, first quarter tax credits is up to $7,000 of tax credits per employee. And then there's another, in second quarter, another $7,000 of tax credits available to employee. And it's 70% of the wages paid up to $10,000 of wages. Now, there are also 2020 tax credits available. We will talk about that. And that one is up to $5,000 in tax credits per employee for the whole year, not for each quarter. And that's 50% of the wages paid up to $10,000. So the goal of this presentation is to show some examples of how you can maximize PPP forgiveness and the Employee Retention Tax Credit, ERTC, sometimes called ERC, okay? So our thought process is if your business qualifies for ERTC in 2021 and you got PPP in 2021, your business should try to maximize both programs through what we're going to call wage segregation, okay? And you need to keep in mind that payroll costs used for PPP, the gross wages, are not available for ERTC. So that's the challenge. But with a good strategy, because most people have not done their PPP forgiveness for 2021, you just need to think about both programs at the same time. So this might seem a little backwards, but I'm going to give you an example about how you can do this, and then we're going to bleed into how you look at especially the ERTC program and the kind of the specifics of how you qualify for it. So let's look at an example about how it can work for you. So in this case, we're going to assume that a business qualifies for ERTC in first quarter and second quarter of 2021. On February 1st, they received $100,000, which is based on an annual payroll of $480,000. And to keep it simple, the business has kept the same number of employees. Your head count does come into the PPP forgiveness portion of the calculations. And we're assuming they have the same one. So if you look at the rules, 60% of the PPP, 60,000, need to be sent on payroll cards in order for full forgiveness. So 480,000, roughly speaking, is about $9,300 a week. And $60,000 spent, if it's just for gross wages or payroll costs, is about 6.5 weeks. So if you take the 24-week forgiveness period, you have until, if you got your money on February 1st, you have until July 19th to spend the money. So the example that I'm going to use in this case, and I'll show you how you get there, but you're going to use your first quarter wages, all of the first quarter, 70% of the wages, all of the first quarter wages for ERTC. You can go from April 1st to May 30th and use 70% of those wages for each employee. And then from May 31st to July 19th, assuming your payroll is $9,000 or $9,300 a week, you can utilize all that money for PPP. So the idea basically is, instead of front loading and using your PPP up from the day that you got it, you just backfill it to the end of the puzzle at the beginning. Now, obviously, the later that you got the PPP money helps out your situation in the first quarter. So I just threw this in because I did this example, and this is an example for 2020. The concept is going to be the same. But in this case, if you got the $100,000 and you got it in 2020, we can use the same concept. So what I have here is how the numbers play out in a real world example. So this is how the minimum requirement for payroll is $60,000. Now you can spend more, but you can't spend less than that 60%. and then you have to demonstrate other forgivable expenses. So this is how it broke down for this particular situation. And the key part of this is that how much ERTC can I get, which is the next slide here. So in this case, there were very few wages in second quarter. So even though in this case, the client would qualify in second quarter, my plan would be is I'm going to use the third quarter of 2020 and all of those wages. And you'll notice that, and we'll discuss this with ERTC, that the owner's wages do not qualify for ERTC. But in this example, 50% of the wages paid, $15,500, all qualifies for ERTC. And then I use the 57,366. So we've just, with a very simple example, made $15,500 in basically think about it in terms of it is bottom line dollars coming to the business. It's not sales, it's not an offset, it's cash coming into the business that you have no direct, other than the calculation cost, direct expenses. So step by step, how I've looked at this is that determine which quarters you qualify for ERTC. Then the next question is, have you submitted your forgiveness application for PPP? For most people that are using it in 2021, you have not submitted the applications because the portals for the bank, most of the banks have not opened yet. So if yes, the covered period of the wages are not available for ERC, so you need to look at that if you're going back to 2021. If no, you have to develop a wage segregation plan like like I showed before. If you're going backwards, you're going to submit a 941, amended 941 and 941X for the quarters you want to claim ERTC. And then you would process your PPP forgiveness utilizing that same strategy, okay? ERTC checks are taking about, what we're hearing is about 6 months to process. Could be more, could be less as more people take advantage of this program. Some people may be seeing it earlier. So I know that was a lot. And Doug is going to jump in here with some more detailed view about the ERTC, because the qualifications for the ERTC have changed quite a bit and has been kind of a little bit of a moving landfill related to this. And I am going to release my screen so Doug can pick up. Doug, are you ready to take over here?
I think so, Dennis. Thank you for your information. Just to point out that even though that was a lot of information, the main thing that everybody online should get out of this is that with proper planning, you can maximize the amount that you get between both the PPP loan forgiveness and the employee retention tax credit. And everybody's going to have a different situation, as Dennis pointed out. So you certainly need to look at your numbers carefully and see how you can maximize your own numbers. So let's get my screen up here.
Doug, as you're taking control, I've got a question here from Jennifer, and I hope I have tried to answer this. We're eligible to claim the ERC in the first and second quarters. Do the wages we choose in the claim PPP have to be in chronological order at the beginning of the period? I think we answered that question, that there is no requirement saying it has to be chronological. So there is so as I demonstrated it, I was trying to push the wages chronologically to the back half of the program. I have talked to other businesses that are trying to segregate possibly by department. There doesn't appear to be any reason why that can't happen also. So that is another potential strategy. So hopefully that answers Jennifer's question. And everybody's going to get a copy of this, so the examples will be in there also. So I'm going to turn it over to Doug here and let him kind of run with it here.
Okay, well, thank you, Dennis. So let's go through what the rules are to see if your particular business will actually qualify for this. And again, we're dealing with the government. And so I call them the if, and, or but rules. Nothing straightforward. And as Dennis pointed out in the beginning, the rules and the interpretation of the rules change almost daily. So you have to keep on top of this. And some of the things that we say now may not apply going forward, or may become more restrictive or less restrictive. So let's get into some of the details as to what we have going on that would qualify you for this. So it's a refundable tax credit against certain employment taxes. And if you do it in the current quarter, which it's too late now because this is June 30th, you're going to be applying for refunds. And especially in 2020 and the first quarter of 21, you'll have to amend your returns, your employment tax returns, the 941 tax returns, to get the refund. So let's get going here. Get my slide to go. All right, so in 2020, the way you qualify, you'll get 50% of qualified wages that you pay your employees after March 12th, 2020 and before January 1 of 2021. And you'll get a credit of up to $5,000 per employee based on $100,000 that you, or I'm sorry, $10,000 that you paid the employees. And that's the max for the entire year between March and January that you can get per employee is $5,000. If you paid them in $10,000 in qualified wages. In 2021, the rules change. You can get up to 70% of qualified wages that the employer paid between January 1 of 2021 through June 30th, today, 2021. That's 70% of $10,000, so that's $7,000 credit per employee. And this is per quarter. As you saw in 2020, it was for the entire period between March and January. In 21, it's per quarter, so you can get $7,000 in the first quarter and $7,000 in the second quarter. Claiming the credit. For the quarters that you already filed, as I said, you'd have to amend your 941 tax return, and you do that on Form 941X, and you go back and claim the refund. For the second quarter of 2021, you haven't filed the 941 yet, maybe unless you and your bookkeeper are right on it and did it today or yesterday. You can still claim that credit on the 941. You don't have to file an amended return. All right, so let's zero in and dig deeper on the 2020 credit. Maximum, as I said, was $5,000 per year, and you must meet one of the following two tests. The operation of your business had to be fully or partially suspended due to orders from the government. Let's see, in which cases apply for qualified wages. Partial suspended is further clarified as a 10% drop in gross receipt when you compare the same calendar quarter from 20 to 2019. So if you had a government order to fully or partially suspend your business, and your revenues went down 10% quarter by quarter, you automatically qualify. Or if gross receipts are 50% less in any quarter, when you compare the same quarter to the previous year, in which case the credit will continue to apply until the end of the quarter when your gross receipts are 80% of the same compared to the same quarter of the previous year. So if you did not have a government order to fully or partially shut down and your receipts did go down 50% in one quarter, you'd continue to qualify for each quarter that you remained under 80%. In the quarter that you went above 80%, you'd still qualify for that quarter until the end of that quarter. A lot of computations in there, I know, but that's the way they wrote it. So a significant decline begins the first day of the calendar quarter that you drop below 50% in that quarter. So you wouldn't know that until the end of the quarter, but then you go back to the beginning of that quarter. That makes sense, I hope. All right, so the decline ends, as I said, the first day of the quarter following the quarter that you go above 80% in gross receipts. And when you compare that to 2019. So qualifies for qualified wages, including health insurance expenses that the employer paid during this period or any quarter in which the operations were suspended. The definition of qualified wages, depending on how many employees you have. If you have more than 100 full-time employees, qualified wages include wages and health insurance that you paid to employees that were not providing services to you. So in other words, you paid wages to keep them at home and they didn't work at home for you, they just stayed home. So that's a pretty high bar to qualify, but that's for employees that had more than 100 full-time employees. If you had fewer than 100 employees, it's very easy to qualify because those are all wages you paid, including health care costs, up to $10,000 that you paid to any employee, whether they worked or didn't work during that period. So they could be working for you on site or at home, and you would qualify for that employee and their wages plus health insurance. This goes back to March 27th, 2020, which is the enactment of the law, and allows employers who received Paycheck Protection Program, the PPP loans, to claim ERTC. And Dennis already went through an example to show you that from March 27th to the point that you got your PPP loan, and whatever dates you asked for forgiveness for spending that money, that period would not qualify for the time that you spent the PP money. But before that date started and after that date started, up until the end of the year of 2020, you can get that up to that $5,000 credit per employee.
So Doug, you bring up a good point there, and this is where the kind of the intricacy of how your PPP forgiveness is done. And one of the things that we all did in 2020, and I'm assuming most people did, is that most companies utilized all payroll for the forgiveness and didn't consider all the other expenses, especially if you were, at that time, if you were over 50,000, because you had to submit a whole bunch of paperwork. And what that basically does is blocks out that period of time for ERTC if you used all wages. Now, if you use the 60% rule, there is, to the question that had kind of come up before, is that you can, if you use 60% of the wages and used like a 20-week period, it doesn't matter which period of weeks you use the wages for. So there can be a deeper segregation, and that's kind of the individual situation, how that applies.
Yeah, unfortunately, last year, the rules were that if you got a PPP loan, you didn't qualify for the ERTC. That was changed with the new law that passed on December 27, 2020. So as you can see that people made plans thinking that they weren't going to qualify for the ERTC. But the good news is you now do. The bad news is some people weren't able to plan properly for that to maximize that out. But there's still ways to maximize out. So look at it carefully and do it as you go. Now the law for 2021 is different in the fact that it qualifies for the 6 months through June 30th of 2021. And as I said before, it qualifies for each quarter. You can get $7,000 maximum per quarter per employee. And you, instead of having a 50% drop, if you weren't, all you needed was a 20% drop in order to qualify for the first 2 quarters of 2021. But again, you're not going to compare it to last year, but you're going to compare it to 2019. New businesses that weren't in place in 2019 can use 2020 numbers, but most businesses are going to be better off comparing it to 2019 if you were in business that year. So again, it's a 20% drop instead of a 50% drop. And again, if you were in a government order to shut down, Dennis, I believe that does a 20% apply, or if you're in a shutdown, is it a 10%?
Right. So if you are under a government order for full or partial shutdown, it now you drop to the 10% of revenues. And there's also 2 other potential streams with that. If you don't have a 10% drop in revenue, you can also qualify by having a 10% drop in what the term is called employee service hours. And there's a little gray in that. And then the other 10% drop is in what's called business modifications. And the example that they gave in their guidance for business modifications was the restaurant business, where restaurant dining rooms were limited to at one time 25% capacity, and then I think it went to 50% capacity, and then it went to 75% capacity. And in all 3 of those instances, that limitation of capacity for the restaurant business does allow you to qualify regardless of whether you had a revenue drop or not. And that is in the guidance that specific example is in the IRS guidance that was published in.
Yeah, we'll be giving you that.
We'll get into that
number now.
Yeah, but that's kind of that's also, Doug, a good example of that kind of grayer area because it can get complicated there.
Right. So again, to reiterate, it's 70% of qualified wages, up to $14,000 in wages, or $7,000 per employee per calendar quarter for the first 2 quarters of 2021. Again, to reiterate the qualifications, a full or partial suspension of the operation of business during this period because of government orders, or the 20% drop in revenue, or less than 80% of gross receipts compared to 2019. Employers that did not exist in 2019, as I said, can use 2020 to do that. All right, so effective January 1, the definition was changed. Now, instead of 100 full-time employees, it's 500 full-time employees in 2019. They qualify if the employees are staying home and they are not providing services. So that's more liberal than the 2020 rules. And for under 500, it's all wages paid, whether they stayed home and didn't work or they did work at home or on site. So all employees qualify if you're under 500 employees. That's a big change, big deal. All right, so what are government orders? An order is from any government agency, including the city, county, state, or federal government, that all non-essential business must close for a specific period. State emergency proclamation that residents must shelter in place for a specific period, other than residents who are employed by essential business. And an order from a local official imposing a curfew on residents that impacts operating hours of a trade or business for a specific period. And an order from a local health department would qualify. If somebody in your workplace came down with COVID and you're required to close down for cleaning and disinfecting, then that makes you qualify. So there's a lot of qualifications there. And let's go through a couple question and answers that there's pages and pages of these. So if you get into this, we're going to give you the citation of where to find these, but these are some of the if, and but rules that are involved here. So the questions are: wages paid by an employer to employees who are related individuals considered qualified wages? The answer that's given in the guidance says no. They are not taken into account for the employee retention credit. A related employee is any employee had the following relationships: a child or descendant of a child, brother, sister, step brother or sister, father, mother, or ancestor of either, stepfather or stepmother, niece or nephew. That's really extending it pretty far, or an aunt or uncle. And son-in-law and all the outlaws are excluded too. So here's the guidance that you or your advisor needs to look at to make sure that you comply with all the if, ands, or buts of these laws. For the 20 credit, it's IRS Notice 2021-20. And for the 21 credit, it's IRS Notice 2021-23. Just to confuse you a little bit, it's not 21, it's 23. But that's it. All right, so I'll give you a second to write those down, because you can just Google those, and there's about 70 pages in each of those that will give you questions and answers that you may run into in your specific situation.
Doug, while they're writing that down, I've got a question. I'm going to read it here. I was a sole proprietor. Do sole proprietors under a DBA qualify for ERTC? In 2021, I switched to an LLC. And the question is, do LLCs that have 2 employees, an owner that takes a draw and an employee that's being paid, qualify as 2 employees?
Okay, so
that are eligible for ERTC.
All right, so as a sole proprietor, whether you're an LLC sole proprietor or just a sole proprietor, first of all, you're not on wages as a sole proprietor, and the IRS and the SBA have not given very good guidance on that. As a matter of fact, they're quiet as far as the owner goes. They did give the question and answers on relatives. So to be conservative, we're interpreting the fact that owners don't qualify, even if it's a corporation and they're being paid on salary. And you saw in Dennis's example where we did not take the credit for the owner, even though they qualified for their wages under PPP up to $100,000 per year. So to answer the question that was given is the sole proprietor doesn't qualify in our opinion, even if you're an LLC. And if you have two employees and they're not related to you, they would qualify. And if you didn't have any employees, then you wouldn't have any credit at all. But if you do have employees and they're not in that relationship circumstance, then they would qualify for the credit.
So Doug, maybe correct me if I'm wrong though, but in order to get the employee retention credit, you would have to have paid wages and have a 941.
Yes. Yes.
Right. So if you're, I think in the example of, you know, that's one of the requirements. So if you that's whether it's a Schedule C or not, you still could have wages. And the qualification of the revenue doesn't necessarily matter about entity, right, Doug?
The qualification,
correctly?
Not what? I didn't hear that.
So I guess the example I would use with a partnership, if the partnership had employees, just by the fact of them being a partnership does not disqualify them from.
No, it's employees, whether you're sole proprietorship, partnership, or corporation or an LLC, as long as you had employees and you properly filed 941s, then yes, you would qualify as long as they weren't related.
Okay. So the next question that rolls in is, does a 501c3 or C6 business have different requirements?
No, they're the same. That I know of. Do you know of any?
I didn't see anything that that necessarily disqualified, but I wasn't looking that one. We might want to get a little more on that situation. But I would say if you file a 941, I think the question is going to be the revenue stream would be the one that you'd have to make sure that gets handled properly, and there may be some guidance on that.
Yeah, they would have the same situation.
Mm-hmm.
You know, if they were ordered to close down, they could be a theater or something like that, and they would definitely qualify. You know,
Okay.
Continue to pay wages.
Right.
All right. So again, we have to put the disclaimer in. Dennis, you want to go through that again?
Yep. So the program has had many changes in published guidance. As Doug said, the two IRS guidances that he said are 70 pages plus. There's a lot of examples in there, and feeling would be is probably subject to change as more of these situations come up. As we saw in some areas, there's some very gray areas that are subject to interpretation, and every business situation is potentially different. Reach out to your tax advisor. Spend a few dollars with somebody reviewing your program that knows about this, and you could save your business either by saying money's available, and you could save thousands of dollars by spending some money up front to look at this. But it can be very complicated. The example that I gave to go through for 2020, it was a few hours of work for me to work through their QuickBooks file, pull out all the information, see what qualifies and doesn't qualify to get to where I got. So it was a good QuickBooks file in terms of all the information was updated and was easy to find.
Yeah, and as Angela said, you know, spending some time and money on this, it goes right to the bottom line. So if you can get $5, $10, $15, or $20,000 in credits, that's a lot easier than trying to get more sales and paying all your operating and cost of goods sold to get $20,000 in the bottom line. because this money goes right to your bottom line as profit if you can get it.
Yep.
And the other thing too is if you apply for it and you didn't qualify for some reason, or you took employees into consideration that didn't qualify, if you get audited and have to pay that back, it's going to hurt you because, you know, most people, when they get money like this, it's already spent by the time the audit comes in, and then they're going to charge you penalties and interest. So you do want to get it right, but don't let that intimidate you. You still should go after it and get it. And if there's any gray areas, if the gray areas can be interpreted properly, put the money in a savings account, and you know, after 3 years go by, if they haven't audited you by then, they won't be able to by statute of limitations. So
Great.
do it properly. I'm not telling you to do it improperly, but because of the way the law changes, or the interpretations changes on this all the time, don't be afraid that you're going to get the money and have to pay it back. Put something in a savings account for 3 years, and if they haven't asked for it back, spend it.
Right, because Doug, correct me if I'm wrong, when you apply for when you do your amended 941 for this purpose, you're not required to submit any documentation to show that you qualify. That's how I've read this, right?
Yeah, no, you have to make sure you keep a file and good records on how you calculated this and where your numbers came from in case you get audited. But that's all you need to do is be prepared for an audit if it happens to come. It's a long shot that you get audited, but always be prepared and have your audit trail ready in case you do get audited.
So, and that's a good point. The other point is in terms of these tax credits is that they are real. Companies are getting money for this. They are getting refund checks. So it's not one of those programs that has you know, kind of floundered, similar to the like right now with the Restaurant Revitalization Fund and the shuttered venue grants that have kind of been chewed up with some litigation. This is real money. It's not a pie in the sky program.
I think it's limited by whatever Congress passed as a maximum that could be given out. I think this is it's not first come, first serve. It's there for you. Is that correct, Dennis?
That is correct. So you know, the prevailing philosophy is that for most businesses, this program is going to end at the end of this quarter. There is, in some very narrow examples, the program does open up that I just got some notice on in the third and fourth quarter of 2021 for businesses that have what they're calling a severe, are severely impacted by the coronavirus. And I think it's like a 90% decrease in business, something like that. But that program will open up. So it more like if your business was shuttered, which there are some businesses that were shuttered, there is a potential for more ERTC for that. But that is a idea that's, I think, coming out. Like I said, I just saw it first thing this morning with a kind of a different nomenclature on it.
Doug and Dennis, this is Angela. I had a quick question. So when you say the program is going to end at the end of the quarter, can people still go back and file amended returns to basically get some money, or is that going to be all done? How long do people have to potentially explore whether or not they can get ERTC?
They actually have 3 years after they filed the original 941 to apply for an amended return.
Okay. I think that's important to understand just because there's a lot to look at. And again, we advise you the SBDC will not be in a position to help you necessarily look at an individualized case whether you qualify or not. This is a kind of above and beyond the services that we provide for disaster assistance. So absolutely connect with a competent accountant or CPA to help you through the ERTC application process to see if you qualify and how much you can get.
Yeah, and I don't want all the procrastinators out there to wait until 3 years. Do it while it's fresh in your mind and the numbers are fresh, because there's a lot of numbers to pull out of this. And you don't want to wait 2 or 3 years to try to figure all this out.
Yeah, and the prevailing amongst payroll professionals, payroll companies, and people that are doing these 941s, prevailing philosophy on this seems to be sooner is better than later in case there are some changes to the program. There is a feeling out there that the amount of money that's out there that companies are already starting to claim, if it grows, there is a little bit of a concern that the program may change a little bit. So everybody's encouraged to try to get in as quickly as possible. That's the latest that I'm kind of hearing out there in the payroll world. I don't know if Doug's heard anything different.
So we're back to a first come, first served basis.
Yeah, I don't think that's, like I said, that's not in the legislation. It would have to go through Congress to change it at this point. But as we've seen in the past, there might be some IRS guidance that I don't see how they would change it at this point, but that's possible.
Yeah.
Doug, we have another question. Do you have to show a decrease in gross receipts in the last 2 quarters of 2021 to qualify for ERTC? If this is talking about the program that I mentioned that for the last 2 quarters of 2021, the comparison appears to be at this stage is that yes, it would gross receipts when you compare your 2021 gross receipts to 2019 quarter by quarter would qualify you for that particular program. But again, that one is fairly narrowly focused, and like I said, I just saw I think it was from got sent something from the CPA on that this morning that I didn't even have a chance to look.
So they have to go down 20% unless they have a government order for partial or full shutdown, and then they only need to be down 10%. Is that correct, Dan?
That's correct for the standard program. That's first and second quarter of 2021. And then, like I said, beyond, once you're under the government order, there's the 10% decrease in revenues, which our position on that, those are the easy things to kind of, it's black and white. But then when you get into the 10% reduction in employee service hours, or the 10% reduction due to business modifications, that's where you really have to start looking at what that means in your particular business, and it becomes a much, let's say, grayer view, right?
Yeah.
Revenues are easy to point to. You can point at a deposit or a invoice and say this is what came in. The other ones become harder, I guess, would be the.
Now, there was one in my other presentation that I talked about. If your supplier is shut down, then you possibly could qualify under the government regulations.
Yeah. Yep.
Ring a bell?
Yeah, that does ring a bell, and that is in that first documentation of that on the IRS guidance. I think the one that ends in 2021-20 is that it does talk about your supplier issue, and that is where it kind of comes into that business modification rule.
Yeah.
I think that's again, that's situational, and it would be important for everybody to really look at it, or have somebody that is familiar with the program to look at it for you, and see if there's a way you can qualify, because I think the potential dollars, like everybody's talked about, it could be a lot of dollars for somebody, right, Doug?
All right, so everybody listening, if you do have questions, we'll stick around for a while and answer them. And if you think of questions after that you should have asked, write down Dennis's email address and go right to the expert.
Well, thanks, Doug. It's a lot to show. So
Yeah.
There's every situation appears to be different. So
Right.
Thank you both. And Doug, I like that you are referring folks to Dennis and not yourself.
Well, you're welcome to come to me, but Dennis is certainly the one in our firm that has been studying this the hardest and applying it to our clients directly. So,
Absolutely. Nope, I understand there. Dennis, was the last question you answered the one from Renee on the decrease in gross receipts in the last 2 quarters? Is that the last one you answered?
yeah, I think I tried to answer that one, and in that case, Renee, if you want to email me once I have that some updated information about the next 2 quarters, I'll be happy to send it to you directly, or if anybody else does.
And just
Sure.
some closing thoughts on my end. You know, this is Angela with the SBDC. So what we've seen since the pandemic is that business owners that have built up a strong outside team, right, composed of good accountant, CPA, the SBDC, connected to a chamber, and have attorneys, have fared much better in terms of being able to access funding through these programs because they get the information first, and they're able to apply oftentimes before funding runs out. So if this wasn't your case, it happens, but as you're moving forward to build a resilient business, make sure that you build up your outside small business team of advisors so that whenever you do run into a situation, you have access to people that are knowledgeable and that can really help you make some money. As you can see with Dennis and Doug, if you're working with the Hoffman Eells Group or another CPA group, a little bit of money, spending a little bit of money can go a really long way in generating quite a bit towards the ERTC or even some other programs. So those are just kind of some closing thoughts on my end of things that I've seen. Unfortunately, people miss out on programs just because they didn't know about it and they didn't have anybody to turn to, like a good accountant, to tap into some of these programs.
Thanks,
Good
thanks,
advice.
Angela. That's a good point, and I think it falls. A lot of those questions usually fall to your internal team, and sometimes the internal team, especially on the administrative or accounting or controller, CFO businesses, that you're so ingrained in day-to-day operations that sometimes some of these things can get by you, and there's some information that is readily available.
I guess if we have you on the line, Doug and Dennis, are you accepting new clients? Because I'm assuming some people on the webinar today might have a bookkeeper that might not be well versed enough to do these calculations. Are you accepting new clients?
Absolutely. We're open for business and here to help small businesses through this.
Awesome. Thank you.
Thank you.
No, we definitely appreciate it, Doug and Dennis. And if you are, I'm sure maybe depending on where you're located throughout New York State, it might be convenient if you touch base with a CPA closer to you, or with everything online, maybe not. But all of our centers do have lists of CPAs and accountants in the area. We won't recommend one, but we do have those resources at the local level if you're looking to connect with one and you're not located super close to us.
Yeah, we do offer virtual services. That's part of our CFO program, is virtual part-time controllers and assisting in things like this.
Very cool. Very cool. You got lots of thank yous, both of you. And Angela, thank you for that last point. It was a nice comment that came in. I do see a hand raised. Let me see if that was for a question and I missed it. Kathleen, you have your hand raised. I'm going to send you a chat and see if you have audio if you want to ask that. Oh, you just put it down. Send me a chat if you do have a question and I can check your audio. But I don't see any other hand raised, and I don't see any other questions because we answered them throughout.
Mm-hmm.
Great. Please make sure you fill out the surveys that you'll receive at the end of this presentation so we know what other topics you'd like to see in the future. In terms of trainings and presentation, the SBDC is happy to bring those to you, but we do want information on what is helpful.
Absolutely. We definitely love the feedback on the survey. As I mentioned, you'll also be getting the recording shortly after this. It will come from an email from GoToWebinar, and we'll also include those slides. Dennis and Doug are usually awesome about providing a PDF of the slides after, and we'll get that out to you.
Oh,
You'll get a PDF. We'll send it out to everybody.
Awesome. I appreciate it. Well, I think we're in good shape. I apologize again that we weren't able to get anybody on camera. I don't know if it's GoToWebinar or if, maybe we didn't want to see each other today. I don't know. We'll see. It's Wednesday, not even Monday.
Maybe it's for the better.
Yeah. Yeah, we're all pretty tired, but we definitely appreciate everyone jumping on. Keep an eye out from that email from GoToWebinar, and as Angela mentioned, please fill out that survey. We definitely look forward to that feedback. I hope everyone has a great day, and definitely feel free to reach out to Doug or Dennis or Angela, or if you're not sure who to reach out to, definitely reply to that GoToWebinar email, and that will go to Angela, and she can figure out the best person for you to talk to.
Great. Well, thank you, everybody, for attending, and thank you, Angela and Renee, for helping us to do this and reaching out and helping small businesses.
Absolutely. We really appreciate your time.
I look forward to the next one.
Yes, me too.
All right.
Thank
Take
you.
care, all.
Bye.
Bye-bye.